We started the week with all eyes fixed on Wednesday's Fed announcement. The anticipation wasn't so much the size of the rate hike, as it was a foregone conclusion the Fed was going to announce a quarter increase to its short-term benchmark rate, but rather it was Powell's presser that followed. What would he say and how would he deliver it? Now, I've got to hand it to the various journalists that wrote that Q&A. I mean, they asked some great questions. They kept Powell on the defensive about the Fed's conviction to continue with their rate hike path and to hold that level steady through the end of the year, even in the face of falling inflation. Now, Powell's remarks, they ultimately fueled a strong rate rally to close out the day. And Wednesday's rate improvements, they continued into Thursday as the European Central Bank, they announced their own rate hike and their own policy announcement that was very rate friendly, pointed to a very positive outlook across the EU. Now, one thing to keep in mind, one thing that has been reiterated by the Fed is that their future decisions will be data dependent, meaning they want incoming data to show inflation and the economy are continuing to slow. And one of those crucial sectors, the labor market. Which brings us to Friday's Employment Situation Report, published the first Friday of each month and serves as the market's most significant monthly report dissecting the health of the labor market. Now, while economists forecasted payroll growth of 185,000, non-farm payroll came in at 517,000, the largest deviation from expectation we've had since August of 2021. The bond market and rates worsened immediately, erasing those gains from Wednesday and Thursday. So you might say, why do mortgage rates care about employment data? So the Fed has been increasing short-term rates in an attempt to slow the economy. They want to curb growth. They want to increase borrowing cost, slow wage growth. Why? Slower economy, slower wage growth, and which translates to less demand, which pushes down prices, which eases inflation. Now, the labor market displaying this level of resilience, it could signal to the Fed that continued rate hikes are necessary to bring inflation down to their 2% target, which ultimately impacts the market's long-term projections, which does affect mortgage rates. But look, with all the volatility to close out the week and considering the magnitude of Friday's payroll growth, we essentially closed the week flat, with really only losing those improvements from the previous 2 days. Now, the next major piece of data will be the all-important CPI inflation report. It's released on Valentine's Day. So let's all hope for some continued inflation love. Remember, as inflation comes down, so will mortgage rates. Hey, if you have any questions about this week's headlines, about these rate trends, or if you're ready to discuss your own pre-approval options, let's talk.